You know how you're watching the stock market, and some stocks just seem to have this magic. The winners just keep on winning, and the losers, well, they just keep losing. It's a puzzle that's been around forever. But what if the answer isn't some kind of market psychology, but something hidden deep inside a company itself? What if you could predict its stock's future just by looking at its DNA? Right, this is the big question. For decades, the go-to explanation for this momentum thing was all about investors. You know, they either react too slowly to good news or they get way too excited and overreact. But a really sharp paper back in 2007 came along and proposed something totally different, an idea that has nothing to do with investor behavior and everything to do with how a business actually works. So let's unpack this momentum mystery. To really get why this new theory is such a big deal, we first have to be on the same page about what momentum investing is and why it's been such a head-scratcher for so long. At its core, momentum investing is incredibly simple. You just buy what's been going up and you sell what's been going down. You're betting that the trend is your friend. The weird part? It actually works. And it's worked consistently for a long, long time, which makes it one of the biggest and most profitable puzzles in all of finance. This is where two researchers, Sagi and Seasholes, jumped in. They looked at this whole puzzle and asked a brilliant question. What if we're all looking in the wrong place? What if momentum isn't about the people trading the stocks, but about the companies themselves? What if the very way a company is built, its costs, its sales, its future plans, is what's actually driving this whole thing? And that takes us inside the company, to its inner workings. To see if they were right, the researchers had to build a model, a new way of looking at what a company really is from a financial point of view. And here's the big idea. They said, stop thinking of a company as just a company. Instead, picture it like an investment portfolio, a bundle of different financial parts, some risky, some safe, all working together. So what's in this portfolio? Well, you've got revenues, which are kind of like your main risky stock. Then you have your costs. Now this is clever. They modeled fixed costs as being short a safe asset. It's this fixed debt you have to pay no matter what. Then you have growth options, the potential for new projects, which are like super risky lottery tickets. And finally, the option to just shut down the business if things go bad, that's your insurance policy. Okay, so how these pieces fit together is everything. Stick with me here. In Scheme 1, if you own two risky things and good news hits, your whole portfolio actually gets riskier, which means your expected return for the future goes up. That's positive momentum. But now look at Scheme 2. Imagine a company with risky revenues but also really high fixed costs. Well, when good news hits and revenues go up, the company actually gets safer. Why? Because those big, scary fixed costs are now a smaller piece of the pie. Your leverage goes down. And in finance, lower risk means lower future returns. So good news today leads to lower returns tomorrow. That's a reversal. So that's the theory. But what does this momentum formula actually look like in practice? Let's visualize it, because seeing these graphs is when it all really starts to click. Check this out. This graph shows what happens to a mature company with high costs. As its value goes up, that's moving from left to right, its risk, what we call beta, actually goes down. See that curve bending downwards? That's because as the company makes more money, those fixed costs become less of a threat, which de-risks the whole operation. And what did we just say? Lower risk means lower expected future returns. So a win today sets you up for a loss tomorrow. That's a reversal right there in the model. But now, watch what happens when we add growth options into the mix. This changes everything. For a company with huge potential, when good things happen and its value goes up, those super risky growth options suddenly become a much bigger, more important part of the company's total value. This makes the whole company riskier, which you can see in this upward bending curve. And higher risk demands higher future returns. So a win today leads to another win tomorrow. That's the engine of momentum, built right into the company's structure. Okay, I mean, that is a beautiful, elegant theory. The logic just makes sense. But it all leads to the billion-dollar question, right? Does any of this actually hold up when you look at the real world, with real stocks and real data? And that is exactly what they did next. This is the moment of truth. They took this theory and slammed it up against decades of actual market data to see if it would break. Let's see what happened. First up, they sorted companies by how volatile their revenues were, basically a proxy for how uncertain their future is. And wow, the results are just incredible. For high volatility companies, the ones with growth options, momentum worked like a charm, earning almost 2.4% per quarter. But for the stable low volatility firms, the strategy actually lost money. It reversed, just like the model said it would. The difference between the two is a whopping 3.16% every single quarter. And just to put that number in perspective, if you annualize it, that's a difference of over 13% a year. Now, in the world of investing, that is not just a rounding error. That is a massive screaming signal that the model is onto something huge. Okay, what about costs? Remember, the theory says high costs can cause reversals. And, yep, look at the data. The low-cost firms, the ones without that heavy anchor of fixed expenses, showed really strong momentum profits. The high-cost firms? Way, way less. The theory holds up again. But this right here, this is the grand finale. They use the market-to-book ratio, which is basically Wall Street's favorite shorthand for growth potential. And the results are the nail in the coffin. The high-growth firms delivered stunning momentum returns, over 3.4% a quarter. The low-growth value firms, barely anything. The evidence is just crystal clear. So after all that, the theory, the graphs, the hard data, what's the bottom line? What's the big idea we should all walk away with? You know, sometimes the researchers just say it perfectly themselves. They found that it's the combination, the unique mix of a company's revenues, its costs, and its growth opportunities that actually determines whether its stock is likely to show momentum or not. It's all connected. So the real key takeaway here is that stock momentum isn't just some random market fluke or a weird quirk of human psychology. It can actually be a rational, predictable result of how a business is built from the ground up. A company's financial DNA really can give you a clue about where its stock price is headed next. And that leaves us with one last really provocative question. If something as powerful as momentum can be predicted using public information about a company's fundamentals, what does that say about the old school theory of efficient markets, the idea that everything is already priced in? It suggests that maybe, just maybe, the market isn't quite as efficient as we thought. And that is a very interesting thought indeed.